Are you playing it too safe in retirement? Hey folks, welcome back and thank you for joining us. Welcome to Master Plan Retirement's Retirement Roadmap. My name is Evan. With me as always, retirement planner Mark Fricks. During this episode, we're going to discuss why playing it safe isn't always the right move, even during retirement. Mark, we see all sorts of people come in with all sorts of histories financially, but especially these days, we're seeing a push in ultra-conservatism on the financial front for accounts and things like that, and investments.
Yeah, a lot of people, folks don't even know what their risk tolerance is.
Right.
They also don't know really where they're positioned. You know,
Right.
they just kind of pick things, or maybe they are told by a coworker, pick this in your 401k. So there's just a wide range of folks that are just in position wrong based on their age, based on, you know, there is some emotion, but you need to get past some of the emotion if you have a long-term horizon ahead of you.
Absolutely. I mean, recent financial pressures, tariffs, inflation, market volatility, we understand they're causing many near retirees to become more conservative with their investments. Completely understandable. As retirees aim to protect savings intended to last decades. However, we see that can be counterintuitive when you're looking at making your money last your entire life.
Well, we kind of saw a big example of that in 2008.
Right.
People that came into us after 2008, because many of them had lost so much money, and maybe they were in their 30s and 40s, but still, we'd have people come in 20 years later still sitting in cash because they just got their heads blown off with 2008 and really emotionally never recovered. You know, and people that either stayed the course, or if they're close to retirement like our folks, we will make moves very quickly. But you got to understand where you're at in time, where you're at in retirement, things of that nature, and not let the headlines drive your emotions.
Well, and people don't often see it that way too, as being overly conservative can be harmful, especially during periods of market recovery. They don't really understand that. I mean, we have had more than one person come through our office who, in 2008, moved everything. You know, the huge drop. They're like, you know what? I'm moving to cash. I'm staying there. And left it there, and you know, we'll talk to them and be like, well, it's been here in cash since then, and you know, it's still grown, but nowhere near what it could have been.
Yeah. Bond rates and savings account rates have been so low. They've been earning 1% to 2% over the last however many years. And a lot of those folks have gotten back into the market now. This is just an example, of course. Right. But COVID maybe triggered a lot of people. And by the way, the year of COVID, the market dropped over 20%, the S&P, but we made money that year.
Yeah.
So if we just left it alone, I know there were weird times, something that not happened in our lifetime for sure. So I can see how people would react. But again, I think that's where people like us come into play. We can kind of pull them back off the cliff, so to speak.
Yeah, I have some numbers I want to share about that, but it's that now that you mentioned that, I don't know. I haven't looked at the actual number of clients we have at this point, but it's a lot. And even during this past kind of rocky part at the end of last year, where's the end of 2024?
A little bit of both. The election
both,
end of 24, when now we're back in the new year, but also during the tariff talk, the initial tariff talk, early 2025.
I can think of two clients that reached out to us out of our whole client, you know, of saying, I need for my own
They've
peace of
been
mind.
educated.
Right. Like they have, whether it's seeing the news headlines that are just made to make you worry and freak out, and but yeah, I mean, we try to educate our clients so they understand why they're positioned certain ways, and that your retirement plan can survive a market downturn, and that's the whole point of making sure that we have that longevity there. So a little bit about these numbers. I want to present a few numbers here. So investors who moved to cash during past downturns, 2008, early COVID-19, 2022. Okay, so they missed significant rebounds. 548% total return from 2008 to 2025. So that's 11.22% annual return.
Nice.
548% total return from 2008 to 2025, surpassing inflation. We'll talk about that in a minute. Right. Fueling a decade-plus bull market until 2020 with substantial gains in subsequent years, demonstrating consistent, powerful recoveries from major downturns like the 2008s, which was a negative 50% S&P in 2008. So we saw that hit. A lot of people felt it.
Right.
But if you had just stayed the course, that's 548% total return. I mean, one of these people I was talking about who stayed in cash without giving up too much information about them, they still ended up with $500,000 in their 401k. Just imagine what it would have been.
But double that.
It would have been unreal.
Yep.
So, I mean, we need the conservatism. We'll talk a little bit about strategies. We need conservatism in certain buckets, certain areas of our finances, depending on need, and we'll talk about those specifics in a bit. But overly conservative portfolios, they won't recover the same way, but they also may fail to keep up with inflation. So that's increasing your longevity risk, which means outliving your money.
Right.
So take a simple example. If you start with $100,000 and inflation sits at 3%, after 25 years, that same $100,000 only buys about $47,760 worth of goods and services. So 25 years, $100,000, the purchasing power is now down to $47,000. You've lost more than half of your purchasing power. And that's just at 3%.
Right, which we believe inflation is higher than that. There are numbers truer than what the government represents. But yeah, again, it's they feel safe. My money's safe, it's protected, it's FDIC insured, it's whatever, and yet you technically are losing money every day you leave it in that cash position. We need some in cash. I think where people have kind of gotten messed up a little bit is that they've gotten used to all their money being in this big 401k, and it's all there. And what I mean by that is when we take money, we take it and we divide it into various buckets, each with a different philosophy or each with a different type of investment parameters. And so each one of them performs differently in different markets. And so that's why overall, and you can't do that with one big 401k.
Right.
I mean, you've got 100 funds, and you could try to maneuver around some of those, and some might make more money than others in certain areas. But do you have a precious metals area? Do you have can you put a 401k into a rental house? No. You can do an IRA that way.
Yeah.
So there's so many things you're missing, but mostly just being able to have specific jobs. As we tell folks, when you're 20, 30, 40 years old, your job in your 401k is to grow. So you, like you're talking about, be more aggressive. You're putting new money in. So even if your funds are down, you're getting more shares for the dollar, right? So just, you're almost better. Now, we do manage 401ks. We manage thrift savings plans. And so that gives them a little bit better return. But even if you don't do that, you're better to set it, get a nice little mix, and leave it alone.
Yeah. I mean, also, another point, many portfolios will drift conservative unintentionally due to the set it and forget it allocation or lack of ongoing review, which is we see that again. Let's take the TSP for example, and this isn't quite a set it and forget it sort of situation, but a lot, I think they still do it when federal employees are first employed by the federal government. Their TSP is completely 100% allocated to the G fund, which is just government bonds. It's basically their cash position as close as you can get to it.
2 or 3%, right?
Yeah, and if they're not taught that, then we've seen people go years in a cash
I've had government workers come up and say, I went to your class, I went back and checked my TSP, I've been with the government 10 years, I've been in G Fund from day one, because I didn't know.
Yeah.
I had no idea I was supposed to go in there and change it, or I had better choices, or whatever. I just thought that's what you went into.
Yeah.
And they've lost out on a lot of earnings. I've had so many people say, where were you guys 10 years ago? And, well, actually, we were right here. So, so.
That's actually a good point. Let's pause for a moment. I would like to direct our listeners and our viewers to our website, masterplanretire.com. There you can schedule your complimentary consultation. It's a simple one-click directly to our calendar. Find a time that works best for you. These consultations are an opportunity for you to discuss your own retirement, your hopes, your dreams, your fears, your concerns. The first meeting is just a conversation, really. We get information from you, and then all the homework is on our end of the table. We run a series of reports, basically a 10,000-foot view of your own retirement. What happens without any planning, just where we are today. What happens when we put the key in that retirement ignition and turn it on? How long does our money last? Where are our problems? Where are our strengths? Let's stress test that retirement a little bit and see areas that need improvement, things like that. All that's completely complimentary. Masterplanretire.com, or give us a call at the office, 770-980-9262.
And let me just say, those reports will probably surprise all the folks a good bit. I mean, I've had a few people come in and they've got their spreadsheets and they're like, hey, I'm never going to run out of money. And I say, how much inflation rate did you apply? Oh, I didn't apply any inflation. Have you looked at what happens if taxes go up? If, and we start putting all these what ifs, and they're like, no, 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 no. And so really they're very accurate, and it's not to plan or make recommendations, as you know, Evan. It is to illuminate. Let's find out what is there so that we can then address it.
Yeah. I do want to backtrack a little bit just because I think these numbers, it's good to hear the actual numbers. When I did mention about the inflation rate at 3%, if you $100,000 over 25 years with 3% inflation rate only buys about $47,000 worth of goods and services in 25 years. But we've already talked about, we think inflation is a little bit more than that. Now think about periods like the years following the pandemic, when inflation hit around 8%. Now I know that was just 1 year. Life is not linear like this, but let's look at that 8% environment. Over the same time horizon, 25 years, you lose about 85% of your purchasing power. That's the kind of erosion that we're talking about that can make even a well-planned retirement start to feel uncertain.
Which is, again, why you have to keep your investments correctly allocated to take advantage of the markets, what they're giving us. Again, we have a portfolio, and I'm not going to discuss specific portfolios, but it's a conservative portfolio that's designed to make money in any kind of market. And it's done extraordinarily well from a standpoint of not being in the negative over the last 25 years. So if I can get a nice something, that's just a pocket of money, though. I'm just saying that's my steady piece of my investments. But then over here, I can take some risk. I can take off a little bit and things like that. So again, it's not, I said this earlier, it probably wasn't a great thing to say, but even if you have a 401k at work, you should be working with someone that can help you reallocate that at least once a year. Because like Evan said earlier, you've got a drift. If bonds do really well, suddenly your 60-40 allocation, I'm being very simple here, right? 60% stocks, 40% bonds, all of a sudden now it's 50-50. Yeah. You've drifted to a more conservative position. If you don't fix that, you're going to be getting less return than you should be getting.
Right.
So again, even if you set and forget it, again, that's probably the best worst case you can do. Okay, so if you're going to mess it up, leave it alone. But maybe if you can get some help, and you got somebody that knows what they're doing to reallocate that once a year, and let's see where we've drifted, what needs to be picked up. Maybe you need a little bit more. Maybe they've introduced some new funds in your 401k, things like that. I know the Thrift Savings Plan has opened up a window of additional funds you can purchase. So you've got to keep an eye on that more than probably a lot of folks are.
Yeah, and really simply put, bonds are great for stability, whereas stocks are really great for growth. And a balance between the two, when Mark says 60-40, is typically 60% equity, stocks, things like that, and then 40% bonds. When that gets out of line, if it's not in line with your retirement horizon and your risk profile, it can drastically affect the performance of that portfolio and your needs and whether or not it's fulfilling the goals that you've set forth for yourself financially. For instance, $100,000 over 20 years, if that's all in bonds, over 20 years, it gets to $185,000 in 20 years. Guess how much it does in stock over 20 years, 100,000?
Let's say 525.
A little low. 844,000. 844,000.
It's amazing.
Yeah. So that's great. And I'm not talking trash on bonds by any means, because we need diversity. We need some safety. We need some income, and there are a lot of other vehicles for income. We'll talk about that. But if you're not properly allocated for yourself and your specific needs, you can miss out on a lot of growth.
Again, just pay attention to it. That's the biggest thing.
Yeah.
And you also don't want to get too far the other way. I know that the title of today's episode is about being, not being aggressive enough. But I've got several people that come in and talk about Bitcoin and cryptocurrency, and I tell people that should not be your retirement fund. That should be your penny stock fund. I can throw some dollars over here because We don't know where that's going. I read an article this morning that was talking a very legitimate economist saying the reason he doesn't believe in Bitcoin, and he cannot find, to his knowledge, a legitimate purpose or legitimate purchase of something using Bitcoin. Now, I don't know if that's true or not, okay? I know for a while you could go buy a car with Bitcoin and things like that. I've not heard as much about that lately. I guess because it's so volatile. How can you buy something when it's worth something different from the time you step on the lot to the time you make the purchase, right? But he says he's not finding legitimate purchases. Mostly it's people gathering it up, making money, and turning it in for cash.
Yeah.
So what role does that play? I don't know. We have a lot of regulation coming, I think, on it as well. I think that might drive the price down. This is not a Bitcoin show. I'm just saying that if you've got all your money going into Bitcoin, you may be being much too aggressive, because if that fails or if that pulls back greatly, then you've shot your one shot and you may not be retiring.
That's absolutely right. Yeah. Please don't put all your eggs in that basket, especially. But
any basket.
Yeah, any basket. But some warning signs, okay, of poor diversification would include, if you own fewer than 10 stocks, heavily weighting in one asset class, weight as in heaviness, weighting in one asset class, overreaction to single company news. We saw Nvidia news over the past few months, but they're still doing well. But
did really well, but then they pull back a good bit, and things like that.
Back again. Sure. So if you are overreacting to single company news, you might be a little bit overexposed and not have enough diversification.
And let me say this with that again: if you get some extra money you want to throw into one particular stock, that's fine. But don't let it be a majority part of your retirement. I know for many years, larger corporations even required 401ks. That 25% of your money or whatever it might be go into their company stock. And all of a sudden you're sitting there with 30% of your stock position in your 401k was in your company. Well, that sounds great until you work for Enron or somebody, or whatever. I mean, there's so many big companies that are no longer there anymore. The Dow Jones turns over every 25 to 30 years. Go back 50 years and see how many companies were in the Dow Jones that are not there today. Okay, so you may say, hey, they've been around forever. No, don't think so. So be careful with that. Right now Amazon seems like a magical unicorn type thing that's never going to go away. Is it Jeff Bezos? Is he the Amazon guy?
Yeah.
He himself said a company's strong position is about 30 years old. How old is Amazon?
Yeah, and they're also not cheap stocks either.
Well, that as well.
So if you're buying it now, make sure
you're not getting a whole lot, and you're buying maybe high, maybe not. It may double in the next 10 years. Right. I don't know, but that's why you don't position all, like your great point, all in one or two or three positions just because they are the flavor of the month.
Yeah, and a couple of the other things to keep in mind: no overlapping funds, especially in your 401k. If you don't know what these mutual funds are, you just see Admiral shares and Vanguard so-and-so and American funds. You don't really know what they're in. You could basically be holding all
buying
the
same stocks.
You never know.
That's true. I know you're buying some of the same stocks.
Some of the same, absolutely. No international exposure is important. If you don't have any international exposure in your portfolio, that might show that you could use a little bit more diversification or concentration in only one sector. These are all things just to consider on your own diversification.
Let's explain sector real quick.
Yeah, great.
That's a great point. So what we mean by sector is if a lot of your holdings are in technology. Technology is a sector, a grouping of like-minded stocks. Healthcare is a sector. Real estate is a sector. So, there's a lot of real estate agents that are really heavy in real estate because they own rental houses. And I warned them, and in 2008 through 2011, a lot of those houses were lost, and they were totally. I've got an acquaintance. He lost 28 rental houses during that time period, which was basically everything he had. And he had to start over. So whatever it is you're in, I can see being in real estate or any other kind of industry, you know that industry, therefore you feel like, hey, I see where it's going, I'm going to make money. If I work for a tech company, I'm probably got my mind more on tech stocks. And so be careful with that as well, because there are more places to make money, and industries change, times change.
To transition that from the need for diversification to how it applies to an entire retirement plan, one thing that does help is making sure you have a withdrawal strategy. Now, we've discussed this before, but in retirement, you need those holdings to start transitioning into funding for your life, into income. So as putting in place a withdrawal strategy can help balance confidence and growth by covering essential expenses, basically, and leaving remaining assets to invested to do their thing. So you create your withdrawal strategy with certain accounts, with certain things you need, whereas with the others you can be much more aggressive or diversified and things like that because you know where your money's coming from. Really all I'm talking about is creating an income plan before anything else.
Yeah, your total not horizon, but your total aim changes from accumulation to bringing money out, or decumulation. We've never decided if that's a real word or not, but decumulation of money coming out. But if you can section that off and say, oh, here's my decumulation accounts, my income accounts, but I still need some growth. Because those income accounts may or may not be keeping up with inflation. So I come over here and I've got 3 or 4 or 6 or 8 portfolios that are making money in different parts of the market. And that's a balanced strategy. I've got my income taken care of. I don't wake up every morning wondering what the market's going to do because my income's coming from a large cap growth fund or whatever it may be. And so it just gives peace of mind. It allows us to create an income plan that is everlasting or lasting as long as that person does.
Yeah, I recently heard that referred to as the flooring approach, and I hadn't heard that before. But that's exactly right. It creates a guaranteed income base to cover monthly essentials, the have-to money, allowing other assets to stay growth focused. And then you've already mentioned the bucket strategy, which we've had episodes on before. Retirement assets are basically split into short term, which is 1 to 4 years, medium 5 to 10, and long term 10 to 30, all different buckets, each with different risk levels, each different tools with different jobs. So we can be riskier in those long-term growth 10-year buckets, and we should be. We should have those buckets allocated for that long-term purpose. But we're okay with that because we have our short-term buckets for immediate needs, mid-term buckets as well.
Yeah, we tell clients on their long-term buckets, when the markets are shaky, just close your eyes. Because it's a long-term bucket. We're not touching it, we don't think. I mean, it's liquid, but our plan is not to touch it for the next 10 to 20 years or whatever that time limit or timeline might be on that account.
That's right.
And so we're going to see greater volatility. So I've got a couple of clients that if they see a drop in a 1-month period, they'll call me. I'm down 2% this month. What's going on? Okay, that's your 10-year bucket. It's up 12% for the year. So let's not worry about it. Leave it alone. You've got other buckets that are making money short-term type of thing. So again, it's a little bit of a change of mentality. I think that's why we spend so much time educating through our classes, through our meetings with our clients, is to kind of change that paradigm from one of gathering to one of harvesting.
Yeah, and there's also a timing the market mentality for a lot of people that we meet, especially if they've done their own investing or chosen their own fundings in their 401ks or whatever. And that's what I hate the term, but investment pornography. Yeah. It's like that's all what that's about. It's like, did you get this stock at the right time? Now is the time. All this other stuff. And if you remember one thing, remember it's not timing the market, it's time in the market, and it's just that consistent long-term growth, compounding interest, and not the next best stock, and making sure that you pick up that huge gain. And
we've got some, probably should have brought it into this episode, we've got some numbers that show if you miss the eight days in the market, of the best 8 days, what your return is like half of what it should have been. If you missed the 2 best days of the market or whatever. And that can happen very easily, again, if you're moving in and out of things because, I saw an article or whatever type of thing. So again, that's emotional investing. And I love the phrase time in the market as opposed to timing the market.
Well, folks, that's it for today. Remember, check out our website, masterplanretire.com, to schedule your complimentary consultation and call us at the office, 770-980-9262.
Lots of resources on that, masterplanretire.com. Hope you'll visit it. But until we see each other again, remember, plan well and prosper. Take care.